Welcome to the Opening Bell Report.
Usually when we sit down to look at an earnings report, especially in tech or crypto, you're looking for the subtle stuff.
Right. It's usually a game of inches. You're looking for a slightly better margin, maybe some guidance that hints at a good next quarter.
Exactly. It's a game of inches. But then every once in a while, something lands on the desk that just makes you stop, put down your coffee, and just stare at the numbers because they don't look real. And that is exactly where we are today. We're doing a deep dive into a financial analysis report dated February 5th, 2026. The subject is IREN LTD. That's ticker symbol IREN on the NASDAQ. And just to set the stage here, we are not talking about a 5% beat.
No, we are definitely not talking about 5%.
The headline number from this report is a year-over-year revenue increase of 355%.
Which, let's be honest, is a staggering number for a publicly traded company of this scale. You rarely see triple-digit growth like that.
Right.
Unless it's like a tiny startup or a biotech firm with a sudden breakthrough. For an infrastructure company, it's almost unheard of.
It's massive. And what struck me immediately is the language in this analysis. The report we're looking at isn't just calling this a good quarter. They're throwing around terms like paradigm shift and inflection point. So today, our mission is to really unpack this document. We need to figure out how a company that a lot of people still think of as just a Bitcoin miner managed to pull this off.
That's the core tension, isn't it? The market perception versus what's actually in the spreadsheets.
We're going to look at their dual-pronged strategy, basically using Bitcoin to fund a huge expansion into AI, and see why this report claims the stock is going through a major re-rating.
And that concept of re-rating is so crucial to get right from the start. It's when the market basically realizes it's been valuing a business using the wrong math. We see the stock price referenced here sitting at $44.94. But the argument this analysis makes is that that price tag doesn't fully reflect the transition IREN has made. They claim IREN has graduated.
Graduated.
Yes. From a speculative miner into a diversified high-performance computing powerhouse.
High-performance computing powerhouse. It certainly sounds a lot fancier than crypto mine. Sounds like something you'd see on a brochure in Silicon Valley. But before we get into all that, the branding and the re-rating, we have to deal with the explosion itself. The report literally calls it the Q1 earnings explosion.
That's a pretty apt description.
So let's look at the raw data. Total revenue for Q1 was $240 million. Now, $240 million is a lot of money, obviously, but in the grand scheme of tech giants, it's not Apple numbers. Why is this specific number such a big deal for IREN?
Well, here is the aha moment the report highlights. To understand the velocity here, you have to look back. That single quarter, just 3 months, generated nearly as much revenue as IREN's entire fiscal year of 2024.
Wait, seriously, you're saying they did in 90 days what previously took them 365?
Essentially, yes. That's the magnitude of the scaling we are discussing. It's not just growth, it's a metamorphosis. It's like a sprinter suddenly running a marathon at sprint speed. And what's fascinating here is that it's not just from one lucky break. If you dig into the drivers section of the report, you see it's a combination of two very powerful engines firing at the same time.
Right, let's break those engines down because this is the dual-pronged strategy the report keeps mentioning. Driver number one is the legacy business, Bitcoin mining. Now, I have to play devil's advocate here. Usually when we talk about mining lately, the narrative is all about how difficult it is. We had the halving, block rewards were cut in half. Logically, revenue should be under pressure. So how is this driving a revenue explosion?
It all comes down to industrial scale physics. The report notes that IR expanded their hash rate to approximately 50 exahashes per second.
50 EHs.
50 exahash. Okay, for the listener who doesn't track mining charts daily, put that in perspective for us. Is that a lot? It's an immense amount of computing power. To give you a sense of scale, just a few years ago, having 5 or 10 exahashes made you a giant. You are a market leader. Reaching 50 puts you in the absolute top tier of global miners.
Yeah.
And because they scaled up to that level, they were able to capture market share.
So it's a pie-eating contest. Even if the pie gets smaller because of the halving, if your mouth is 10 times bigger than everyone else,
we still get fed.
Yeah.
Exactly. Even though the Bitcoin halving dynamics, as the report calls them, make it harder to earn Bitcoin per machine, having that much raw power allows you to grab a bigger slice of the total rewards. They essentially outmuscled the market.
Okay, so they won the arms race on the mining side. That explains the base. But then we get to driver number two, which is where the story really shifts for me. This is the AI cloud revenue.
This is the pivot point. This is where the story changes genres.
This is the part that piqued my interest. Because for a long time, I feel like every crypto miner was issuing press releases saying, oh yeah, we're going to do AI too. It felt like a buzzword.
You're right to be skeptical.
A way to pump the stock. Because AI was the hot trend.
A lot of it was aspirational or strictly experimental. Companies bought a few GPUs, put out a press release, and hoped for the best. But the report is very clear on this. For IREN, This segment is no longer experimental. It has become a material percentage of their top-line revenue. This isn't a pilot project anymore. It's a core business pillar.
And that fundamentally changes the nature of the cash flow, doesn't it? It's not just about making more money. It's about making different money.
Completely. I mean, think about the profile of Bitcoin mining revenue. It's volatile. The price of Bitcoin goes up, it goes down, difficulty changes, luck plays a factor.
Right.
It's unpredictable.
Right.
But AI cloud revenue, that is stable, recurring contract revenue.
Right. You're signing leases effectively. You are a landlord for digital brainpower.
Exactly. You're leasing compute power to AI companies for 6 months, a year, 2 years. You know exactly what that check is going to look like next month.
Yeah.
It balances out the volatility of the crypto side.
So you have the explosive, albeit choppy upside of Bitcoin, combined with the steady, predictable paycheck of AI contracts.
That's the mix. And that combination is what delivered that $240 million quarter. It's the best of both worlds, high growth potential plus stability.
But, and there is always a but in these high growth stories, revenue is vanity, profit is sanity, right?
Yeah.
I feel like the classic knock on this entire sector has always been growth without profit.
That is the historic bear case, yes.
You know the drill. Look at all this money we made. Just don't ask how much we spent on electricity to make it.
It's the hamster on a wheel problem. You run faster and faster just to stay in the same place because your hardware is getting old and your power bill is going up.
So how does IREN stack up in this report? Did they burn the furniture to heat the house to get that $240 million? Because if they lost $50 million to make it, that's a very different story.
According to this analysis, no. And this is the second major pillar of the report, the profit pivot. IREN posted positive net income. They achieved GAAP profitability.
And we should stress, GAAP profitability is the gold standard. We aren't talking about adjusted EBITDA or some creative accounting metric where they exclude all their real expenses.
Correct. This is actual bottom line profit, and that is incredibly difficult for a miner to achieve. Why? Because of depreciation. Mining rigs have a short shelf life.
Right, maybe 3 or 4 years.
Exactly. So you have to write down their value constantly, which usually drags your net income into the red, even if you're cash flow positive.
So if they are GAAP profitable, despite that heavy depreciation,
it means their operational efficiency is just off the charts. And if we want to understand why, because that's the important question, we have to look at their infrastructure. The report explicitly cites their low-cost renewable power.
I see mentions of the Childress and Canal Flats sites here. These are their data centers.
Yes, those are their locations. And by securing low-cost power at those specific sites, they preserved their margins. Energy is the biggest cost in this game. If you pay 4 cents for power and your competitor pays 7 cents, you win. It's that simple.
It's a structural advantage.
It is.
Okay, let's look at the metrics that prove this financial health. The report lists operating income flipping to positive $31.26 million. But there's another number here that caught my eye, EBITDA.
Right, earnings before interest, taxes, depreciation, and amortization. It's a measure of raw operational cash flow. The report puts their trailing 12-month EBITDA at $285.7 million.
Nearly $300 million. That is serious cash flow. That's not startup money anymore.
It is. But if I really want to highlight the health of the business, I'd point you to the cash flow quality section. Look at the operating cash flow to sales metric.
It says it's hovering near 32%.
Think about what that means. For every single dollar of sales IREN brings in, the company keeps 32 cents as cash from operations.
That seems really high. I mean, for a hardware business.
It's very healthy. In a capital-intensive industry where you have to buy expensive chips, build massive warehouses, and pay for megawatts of electricity, keeping 32 cents on the dollar is incredible efficiency. As the report notes, this is a hallmark of a healthy, mature business. This isn't the profile of a speculative crypto operation that's just hoping Bitcoin goes to $1 million to bail them out. This is a business that prints cash now.
It's funny you mentioned speculative operation because that leads us perfectly into the growing section of the report. This is where the valuation stuff gets really interesting. Because if they are printing cash, how much are we paying for that cash printer?
This is the so what part of the deep dive. This is where the rubber meets the road for investors.
Right. So the report points out a discrepancy. It says IREN trades at a price-to-earnings ratio, or PE, of roughly 26x. Meanwhile, a lot of their traditional mining competitors are trading around 10x. So on the surface, IREN looks expensive. You're paying a premium. The question is, why? Why pay 26 times earnings for IREN when you can get brand X miner for 10?
And the answer, according to this analysis, is the AI multiplier. The market is assigning a premium because IREN isn't just mining anymore. They are powering the AI revolution.
And we aren't just talking about vague AI capabilities. The report gets specific about the hardware. They name drop some heavy hitters.
Very specific. They highlight the aggressive deployment of NVIDIA H100 and B200 GPUs.
The H100s and B200s. These are the Ferraris of the computing world right now.
Actually, they're more like the freight trains. They are the heavy lifters. These are the industry standard for training large language models. Everyone wants them. OpenAI, Google, Meta, you name it. There is a massive global shortage.
Right.
And because IREN has them and has the data centers to actually run them, which is not trivial, their utilization rates are effectively capped out.
The report says near 100% utilization rates.
Which is because of that global shortage of compute power. If you have these ships online and cooled, you have customers. It's a seller's market. You don't have to go knocking on doors. People are knocking on yours.
So because they have the hardware that everyone is desperate for, they command a premium valuation. It's supply and demand.
Precisely. But it's also about the future mix of revenue. The report cites an analyst projection that is quite bold. By the end of fiscal year 2026, AI cloud revenue could rival mining revenue.
Wow, so a 50-50 split.
Potentially. And if you are an investor, that is a dream scenario. It creates that stable, recurring contract revenue we talked about. If you're just a miner, you're valued like a commodity producer. Think of a gold mine or an oil driller. Low multiple, high risk. But if half your revenue comes from high-tech contracts, you start looking less like a miner and more like a tech SaaS company.
And SaaS companies, software as a service, get much, much higher valuations than commodity miners.
Exactly. That explains the 26x PE ratio. The market is starting to price them as a technology infrastructure provider, not just a Bitcoin proxy. The market is saying, we see what you're building, and we're willing to pay more for it.
Okay, so we've established they're making money, they're efficient, they're pivoting to AI. But now I have to ask the question that every listener is probably thinking. The stock is at $44.94. We've seen this huge run-up. Is it too late? Did we miss the boat?
That is the valuation analysis section of the report, and interestingly, despite the stock being at $44.94, which is down from its highs, by the way, the report suggests the growth story is really just beginning.
And they use a specific metric to make this case, the PEG ratio. Now, I know PE, but walk us through the PEG. I feel like this is one of those metrics that gets ignored, but is actually super useful.
It is the single best metric for high-growth companies. PEG stands for price earnings to growth. It's a way to contextualize the price you're paying relative to how fast the company is growing.
Right.
Because a PE of 26 sounds high if you're growing at 5%, but it sounds pretty low if you're growing at 50%.
So it balances the sticker price against the speed of the engine.
A great way to put it. The formula is just the PE ratio divided by the growth rate.
Okay, let's do the math on the fly here to make sure we get this. We have a PE of roughly 26, but we have a growth rate of 355%.
Right. So you take 26 and divide it by 355.
That's going to be a tiny number.
It's less than 0.1.
Okay, what does that mean in English? Is low good or bad?
Low is very good. Classically, a PEG ratio of 1.0 is considered fair value. Anything under 1.0 suggests the stock is undervalued relative to its growth. A PEG of less than 0.1 it's extremely rare. It implies the market hasn't fully caught up.
That is wild. It's basically saying, yes, the price looks high compared to current earnings, but the earnings are growing so fast that the price is actually cheap.
That's the logic. It suggests the market is pricing the stock based on what the company was, a miner, rather than what is becoming a rapid growth AI host. And the report goes a step further with a forward outlook. They calculate that if IREN sustains even half of this growth rate, let's say 150% over the next 4 quarters, the forward PE would drop into the single digits at current prices.
A single-digit PE for a tech infrastructure company. That's almost unheard of. Microsoft and NVIDIA trade at like 30, 40, sometimes 50 times earnings.
Exactly. It would be incredibly cheap. But again, that assumes they can maintain that execution. It's a big assumption.
Right. It's a projection, not a promise. And that brings us to the conclusion of the report. They sum it up as the bull case. They argue that Q1 wasn't a fluke, but the result of a multi-year infrastructure strategy coming to fruition.
It's the validation of the long game. They built the data centers, they secured the power, and they ordered the chips when everyone else was hesitating. They were planting seeds while others were just harvesting.
The report also takes a bit of a victory lap on refuting the bears. We touched on these, but let's list them out clearly. Bear case 1. They burn too much cash.
Refuted by positive net income and that 32% operating cash flow margin, they are self-sustaining.
Bear case 2. They are just a Bitcoin proxy.
Refuted by the surge in AI revenue and the diversification strategy, they are proving they can make money even if Bitcoin goes sideways.
So, the final verdict from this analysis.
They believe IREN has successfully transitioned into a profitable growth company. They view the current price of $44.94 as a disconnect, a gap between market fear and the company's specific fundamental explosion.
It's a compelling argument that paints a picture of a company that has sort of transcended its origins.
It really has.
And that leads me to something I've been thinking about this whole time. The report keeps using this term inflection point. And it makes me wonder, if a company successfully transitions from being a commodity miner to a high-tech AI provider, does the market eventually stop caring about the price of Bitcoin entirely when valuing that stock?
That is the ultimate question. That is the holy grail for these companies. Right now, the two are still linked in investors' minds. You see Bitcoin drop 5%, IREN drops 5%, almost automatic.
Yeah.
But if that AI revenue line crosses the 50% mark, if the majority of their money comes from NVIDIA chips and AI contracts, then yes, we might see a total decoupling. At that point, the price of Bitcoin becomes a nice bonus, not the main event.
A bonus dividend, rather than the entire business model.
Precisely. And if that happens, the re-rating we talked about at the beginning, we might only be in the first inning of that, because the market will have to completely rethink what kind of asset this is.
Well, it's certainly a fascinating evolution to watch, from mining rig to AI data center, a true inflection point.
Indeed. It's one for the watch list.
That is all we have time for on this deep dive. As always, remember that we're analyzing a specific report here. This is impartial analysis of the Q1 earnings explosion document, and none of this constitutes financial advice. Do your own research, check the charts, and maybe read the report yourself.
Always check the sources.
Thanks for listening, and we'll catch you on the next deep dive.
Don't forget to like, share, and subscribe for more.